Welcome back, dear students and scholars. In this first ASC 310 lesson, we are standing in the receivables control room. A receivable may look like a simple right to collect cash, but before measurement begins, we need four checks: when cash should arrive, what type of claim it is, whether collection risk exists, and whether the claim has changed hands. That simple line can hide a full accounting investigation, so this video builds the map before the numbers arrive. Receivables often appear as clean balance sheet labels: accounts receivable, notes receivable, loans receivable. But behind those labels, the accountant has to ask much better questions. Is the customer likely to pay? Is the cash due soon, or is there a long term financing element? Has the receivable been modified, sold, or transferred? So do not underestimate receivables. They may sit quietly on the balance sheet, but sometimes they carry more drama than a suspense movie. This video is the foundation map. We will not jump directly into formulas or journal entries because measurement without scope is like calculating the speed of a train before checking which track it is on. First, we identify what ASC 310 is, then we define a receivable, narrow that into financing receivables, separate what is inside and outside the topic, and finally connect ASC 310 to the standards that take over for credit losses, interest, transfers, derivatives, and revenue. ASC 310 is built around two major subtopics. ASC 310-10 is the overall subtopic. It gives us the main framework for scope, recognition, measurement, classification, and transfer links. ASC 310-20 focuses on non-refundable fees and costs such as loan origination fees, direct loan origination costs, commitment fees, and yield adjustments. So the first subtopic tells us what receivable we are dealing with. The second explains how certain fees and costs affect income over the life of the instrument. At the core, a receivable is a recognized right to collect cash or another financial asset from another party. The important word is recognized. A hope, a plan, or a possible future sale is not enough. There must be a real claim that belongs on the balance sheet. That claim may come from goods sold on credit, money advanced to a borrower, or a signed note. Once the claim exists, the next question is not just how much is owed, but what kind of receivable it is. A financing receivable is a more specific category. Think of it as a contractual cash claim that is due on demand or on fixed or determinable dates. This can include trade receivables, loans, notes receivable, credit card receivables, certain lease receivables, and other recognized financial assets. The key idea is that the entity has a contractual path to cash. ASC 310 helps identify that path, while the credit loss model itself is handled through ASC 326. Now let us look inside the scope. ASC 310 commonly covers trade, accounts receivable, loans, loan syndications, factoring arrangements, standby letters of credit, and other lending arrangements that meet the cash claim definition. The practical lesson is simple. If the asset arises from lending, financing, or credit based collection rights, ASC 310 is usually part of the analysis. But being inside the topic does not mean every related accounting question is answered there. Some questions quickly move to other standards. The outside scope list is just as important as the inside scope list. Debt securities belong under ASC 320. Certain contribution promises follow non-profit contribution guidance. Transfer or retain interest in securitizations and purchased beneficial interests have specialized guidance. Mortgage banking activities and derivative contracts also move to specialized standards, especially ASC 815 for derivatives. Scope exclusions are not footnotes to ignore. They are warning signs that tell us not to force ASC 310 onto the wrong asset. These four receivable types are in the same family, but they do not behave the same way. A trade receivable usually comes from ordinary credit sales and is often short term. A note receivable has more formal written terms. A loan receivable comes from funds advanced under a lending agreement. A credit card receivable is revolving and changes as customers borrow and repay. Classification matters because documentation, risk profile, payment pattern, and disclosure needs can be very different. Three special arrangements deserve early attention. Factoring means receivables are sold to a third party factor, and the big question becomes whether the transfer is a sale or a secured borrowing. A standby commitment may create exposure before the actual loan is funded. Rebates involve returning finance charges or fees after early payment, which affects yield. The common principle is substance over label. The accounting follows the economic reality, not just the wording of the contract. ASC 310 is not a loan. ASC 326 takes over for current expected credit losses. ASC 835 deals with interest imputation when rates do not reflect market economics. ASC 860 evaluates transfers and servicing, especially for factoring and securitizations. ASC 815 handles derivatives, and ASC 606 often explains how revenue transactions create receivables in the first place. Also, remember that the old creditor troubled debt restructuring model was removed, so we do not build this lesson around old TDR accounting. Let us close with the memory sequence. First, identify the cash claim. Second, check whether ASC 310 applies. Third, classify the receivable type. Fourth, identify related standards such as ASC 326, ASC 835, ASC 860, ASC 815, or ASC 606. Only after that do we move into recognition and measurement. In the next video, we will see how receivables enter the balance sheet and at what amount. If this helped you, please like, share, subscribe, support the channel, and share it with your colleagues.